Okay, hello and welcome to today's webinar. My name is Mark Hodge. I'm head coach at Rockwell Trading, and I'm going to be covering a topic that I find very fascinating. It's how to trade with market volatility. Now, before we get started, it's important to understand that trading does involve risk. So most of you have seen this before. I just want to go through it real quickly. Trading futures, options on futures, and retail off-exchange foreign currency transactions involves risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial situation. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Should not be new to you, and as a trader, you must understand that there is risk with any transaction, and of course, we're after the reward, but we need to understand that risk is a function of any trade that we take. So, with that out of the way, today's session, well, we're really going to cover three things. One is how to gauge and assess market volatility so you understand the type of environment that you are trading in as a trader. The second topic is going to be how to use volatility-based profit targets and stop losses with your trading. I'll give you some ideas and some tips based on how I spot opportunities or how I manage exits depending on volatility in the market. And I'm going to share how to create extended support and resistance levels based on market ranges. This is a real neat idea, and it really helps out when you get some of those big days like we had in August in particular, where you have that excessive volatility. Understanding where some of those extended support and resistance levels might be could really help you if you're a trend-following trader looking for the directional move to continue, but just not sure how much more of that trend is realistic or an option for you. So let's cut to the chase and get right down to it. Why care about volatility? Well, you'll typically see, and these are general statements, that greater volatility usually means larger price swings. And on the flip side of that, lower volatility usually means smaller price swings. So what does this do? How does this affect us as traders? Well, it does have an impact on our emotions. When markets have low volatility and you see very small price swings, it's very easy to be in the market. I mean, you might have unrealistic expectations on how far a market might move, but it's comfortable, it's easy. That's when you see indices moving higher and just money kind of going into the market without any major concern. So emotionally, it's easier to trade when there's lower volatility. However, the trade-off, and here's the tricky thing, traders actually embrace volatility. I mean, we welcome volatility because as traders, we want markets to move, and we hope that we're on the right side of the market when we are trading and there's volatility in the market, but we want markets to be moving. We want markets to be more volatile, but with that comes potential greater risk. So there's an emotional play at hand here when we talk about volatility, and depending on the type of market environment that you're trading in. And that's why it's so important to understand the difference between lower volatility trading environments and higher ones, and what to do, so you're armed with tools and tricks, that are at your disposal so you can trade any type of market environment. And then another thing that is important and why you should care about volatility is by understanding volatility, you can determine what would be considered a realistic profit potential. I mean, it might be that you're a swing trader, you're trading currencies, and you're thinking, yeah, the 500 pip target in the euro US dollar sounds great, but it might be completely unrealistic for the time frame in that you're trading. Yeah, it would be great if you were able to lock in that type of move, but you need to understand what type of moves are realistic. Is the market moving 50 pips a day, or is it moving 200 pips a day? And that's going to help you set realistic profit targets. Understanding the type of trader you are, whether you're a swing trader or day trader, will also be affected by volatility. And then last but not least, this affects the amount of risk that you are going to take on every trade. Because again, with greater volatility, we can go for those larger moves, but we have to be willing to risk a little bit more. And with lower volatility, we don't have to risk as much, but then the reward is also going to be smaller as well. So these are reasons to care about volatility and why you should understand volatility and ways to assess it, really regardless of the type of trading that you're doing. Now, moving on. How do I incorporate volatility into my trading, and how can you incorporate volatility into your trading? Well, I think that the easiest thing to do are to understand and to use a concept that we call the average daily range. And the second thing, which really goes beyond the scope of this webinar, is completely different topic, but something that I do as a trader, is to chart my markets using range bars. Now, understanding and how to use the average daily range is something that I'm going to talk about in today's webinar, and that's going to be the focus. Is actually an article that I had published in Technical Analysis of Stocks and Commodities. I think that goes back 2 years now. But that's what we're going to talk about in more detail here in today's session. So, what is the average daily range? And I will use the average daily range and the acronym ADR interchangeably during the webinar. But the average daily range is simply the difference between the daily high and daily low averaged over the last 7 days. So basically, it's just the moving average of that difference over a 7-day period. Now, there's been some loose discussion on daily ranges. I mean, you've probably heard that term before. I know in some software packages, it comes up as an option. But the first time I really became aware of it being a quantified number, something that was actually created and used as an indicator, was from my CEO, Mark Hodge here at Rockwell Trading. And that is by using a 7-day average, we're able to come up with a number to get that average range and to understand it. Now, there's average true range too. The average daily range is actually a easier number to calculate, and in my opinion, with the overnight markets and accessibility that we have to trade markets, it's actually more relevant in this day and age. When average true range was created, the idea was to assess gaps in the market, and the calculation is basically a calculation to incorporate gaps in the market. And since we know that now we're basically trading a 24-hour trading environment, I think that the average daily range is actually a little more relevant in this day and age. So what do we do with the average daily range? Well, there are a few benefits and a few things that I get out of using the average daily range and understanding it. The first is to assess recent market volatility and to understand your trading environment. Now, when you start to do that calculation, and by the way, I have it calculated in my software program, so every day I can see exactly what the average daily range is. It's calculated for me. I don't have to do it manually. Otherwise, if you want to do it manually, it probably is a 1-minute calculation. You would just drop the furthest date in that 7-day average and add the most recent difference between the session high and low. Otherwise, talk to the tech support for the software company that you're using, and it should be pretty easy to just create that indicator and have it calculated for you every day. So going back to assessing recent market volatility and understanding your trading environment. Again, as a trader, I focus on day trading. And I'm looking at intraday moves, and I'm looking to take advantage of those moves during the trading day. But if I'm not paying attention to the average daily range, really there's no basis for recent market moves other than just my assumptions on the market. Again, if I'm looking at an average daily range that is increasing every day, if we're trading the euro against the dollar, let's say, and the average daily range on one day is 150 pips, and then it's 160 pips the next day, 170. If it's creeping up to the 200 pip average daily range, and I know that we're trading in a more volatile market based on the average range. The average range is getting larger from the session high to the session low, and it's staying that way based on that moving average. So that's something that I could use when I'm looking at opportunities in the market. And if it's getting smaller, that's telling me that there's lower volatility in the market. The second benefit here is to prepare for potential market moves. We I use pivot points. I love pivot points, and as a day trader, I find that they are effective. And you could also use like round numbers in currencies. We know that there's a lot of attraction to those levels. Of course, it depends on the type of trading that you're doing. If you're looking for small price fluctuations in the market, it might not be as important to you as someone who, it might be more important for you because you don't want to hit any level of support or resistance with a small market move, where if you're, a swing trader, it might not be as much of an issue for you. But as a day trader, I want to know, where's the potential? If the market's already moved, let's say 200 pips, and I know that that's the average daily range, and I'm looking for a 50 pip move, then that might not be a realistic goal for that day based on the trend that is at play. And we'll look at a chart. I'll show you what I mean. But the bottom line is, if the average range, if we are exceeding the average range on a move, then I know that in general, once we start to get into those, exceeding those average ranges, there's a good chance that we're going to get a pullback, or it's going to be difficult for the market to continue. It doesn't happen all the time. Of course, we need those bigger days. We need those breakout range days to affect the average daily range and to get bigger average daily ranges, but that's something that I see time and time again. And I will share a chart to show you exactly what I mean by that. We could see, where the average daily range would be. And then lastly here, benefits of the average daily range, I can take the average daily range and I can use it to make decisions on my exits, based on volatility in the market and the average daily range. I can use larger stop losses when there's greater volatility, larger profit targets when there's greater volatility. And that's a major benefit to understanding the ADR, or the average daily range. Now, I want to talk about ways to use the average daily range to determine profit targets and stop losses. Before we do that, just in general terms, let's quickly talk about the types of exits that you might use as a trader. I mean, all exits are really going to be based on four underlying principles. One is a fixed target and stop. A fixed target and stop should be based on your testing, or experience, let's say. But a fixed target and stop is just that. Say, as a day trader, you're looking for a 30 pip profit target every time you identify a trend, and you are willing to risk 20 pips for that move. And that's what you do every time you identify a trend in a market, and it's fixed. It doesn't change. Now, the advantages of a fixed target and stop is that it's easy. With your programming, if you're using auto exits or bracket orders, once you've entered a trade, it stays the same. You don't need to make any adjustments. You don't have to determine the average daily range each day. It's very, very easy. But it could be that fixed targets and stop losses might be too large when the markets are less volatile and very, very quiet, and they could be too small when you have hyper volatility in a market. There's also a percentage-based exit, and this is probably more common in stocks, where you base your exit. Let's say you're looking to make 20%, or you're trying to set a profit target that's 20% of the the underlying security, and you're using a 10% stop as a swing trader, or something along those lines. Percentage-based would be something that you would have to calculate based on your entry point. Volatility-based would be using the average daily range, which we will talk about. And the last, though, would be a technical exit. Technical exit would be maybe placing your profit target in a short trade right above a major support level. Maybe if you're going long, you're placing your stop loss right below a major support level as well. So, now that we know the different types of targets and stops, I'm going to focus on volatility-based exits, which change daily, because we want our exits to reflect the market volatility, what we expect based on the ranges and based on the averages that we have going into that trading session. Now again, I am a day trader, and based on the average daily range with trend following strategies, when I'm looking for a market to trend, I will use a profit target that's based on the average daily range, and I will use a stop loss that's based on the average daily range. And the advantage here is that when we have lower ranges and there's less volatility in the market, we are going to have smaller stop losses, and we are going to have smaller profit targets. Now, there's a trade-off. We're going to be risking less because of that lower volatility. We're also going to be making less because of that lower volatility, but it's going to be realistic for the market environment that we're trading in. And by using a percentage of the average daily range here, you see here that as a day trader, I find 15% and 10% to be appropriate. And then that way, if I am wrong, if I'm losing money, I could always be positive, even if I'm wrong half the time with my trades, because I'm always going to make more with my profit target than I will with my stop loss. Now, these percentages could change a little bit if you are swing trading, and you could even increase the ratio. Maybe a larger average daily range. Maybe you go one full average daily range for your stop loss as a swing trader, and a 2 or 3 average daily range for your target. As a day trader, I'm looking for more entries. I'm looking for more opportunities during the day, so 10% and 15% is appropriate. So let's look at an example, and then we're going to go to a chart, and I'm going to show you exactly what I mean. So if the Euro-US dollar has an average daily range of 150 pips, 150 pip range with a 10% average daily range stop loss is going to be a 15 pip stop loss. If we're looking at a 15% target, then this would be a 23 pip target. Now let's say this changes. If it goes down to 100 pip average daily range, remember that's the average over the last 7 days. Now I'm risking 10 pips with my stop, and I'm looking to make 15 pips with my target. And, of course, this fluctuates as ranges change. If I'm looking at a 200 pip average daily range, a 10% stop would be 20 pips. A 15% target would be 30 pips. So my targets and stops adjust depending on the volatility that we have in the market. And let's look at an example here. This is a chart. Oh, let me make sure I change I need to grab it with HotCom. Does everybody see my chart now? Okay, perfect. And Wiki says it's less than a 1-to-1 risk to reward. No, my reward is 1.5 to each, for the amount that I am risking. Okay. So based on, again, this is something I've programmed into my charting software. It's easy to calculate by hand, but you could probably, depending on the software that you're using, make it very easy to get these calculations and have it be programmed into the software that you're using. But we see here that the average daily range currently, let's take a step back. This is the Euro futures contract. As a trader, I trade futures, but the Euro contract is basically representing the Euro against the US dollar in spot Forex. So it's going to give us the same type of movement. It's just traded through the CME, through an exchange, that really being the difference there. But we see here, top of my chart, that the average daily range based on the last 7 days is 175 ticks or pips. So based on this average daily range, 15%, it's calculated for me, is a 26 tick target, and my stop is 17 ticks. Let me just write this down just to make sure it's easy. I don't know how small that is, but with the average daily range at 175, we'll say pips to make it easy. I know that as a futures trader, you'll probably hear me say ticks and pips interchangeably throughout the webinar today. Bear with me, but we'll try and keep it pips since I know many of you are currency traders here. So based on the average daily range, if we're looking at 175 pip range ADR times 10%, that this would be 17.5. That's going to be my stop loss. 175 ADR times 15%, well, that's going to be my software is rounded up for the target, it looks like, and down for the stop. But either way, that's fine. And we'll just say rounded to make sure if anyone does the math. I mean, really at this point, one tick pip difference isn't going to really matter. But based on my calculations, I'm looking for a 26 pip profit, and I'm willing to risk 17 pips. Now, it's not less than 1-to-1 because 1-to-1 would be a 17 pip target, 17 pip stop loss. It's 1.5-to-1, and based on the type of movements that I'm looking for smaller trends in the market, and I'm looking to identify, this way I might get a couple of moves a day. Now, I use this with a strategy that we call our simple strategy. If you're interested in learning more about the strategy, excuse me, actually, Active Trader. In November, there's going to be an article on the simple strategy in Active Trader, and we have a few webinars available on the concept. We might even have one archived on FX Street. I'm not sure, but anyway, to make it easy for today's session, what I'm going to do is just to show entries and to kind of show you how the average daily range target and stop works and how it might be valuable to you. I'm going to use MACD and just use a simple MACD system for entries, and I'm going to use the average daily range for my exits, right? So the rules are going to be go long when MACD is above the 0 line and above the signal line. When these conditions are met, we're going to have a green bar. I programmed this into my software, but again, you can just look at MACD to make that entry decision. So that's going to be our entry rule for a long entry. Our entry for a short entry is going to be when MACD is below the 0 line and below the signal line. Whenever those conditions are present, we will have a red bar. Now, black bars mean that there's a MACD crossover, but MACD in relation to the 0 line isn't right for those rules. So like here, MACD is below the 0 line, but it's not below the signal line. So when that happens, we have black bars. Just like here, MACD is above the signal line and the 0 line, and then MACD crosses back over, giving us black bars, and then when MACD gets above the signal line again, then we get green bars once again. So our entry rules will be based on those conditions, and whenever we get a green bar to go long, whenever we get a red bar to go short. Now, starting at the very beginning of the day, this was the first bar that completed for the session. It's green. So based on our MACD rules, we look at an entry at 36.80. And this is just to give an example of the average daily range target and stop loss. 36.80 would be an entry point. Because I'm using a 17-tick stop loss, my stop loss is going to be, even lower, my apologies, 36.63. And I'm using a 26-tick profit target. So my profit target is up here. At 37.06. So we see, just using the average daily range for our target and our exits, we see that our stop loss is appropriate for this market. We get the move on up to our target, and that would be a reason to get out of a trade. Now, when our conditions are met for a downtrend again, I'm using a 20 or a 12-tick range bar. Sorry, again, I'm using this just as an example. A 12-tick range bar is what I use for my trading, but my goal in the webinar is to discuss exits based on the average daily range, not so much entries. Otherwise, we could do a whole workshop that's 4 hours long on everything here. But based on our rules, we have a red bar. So MACD is bearish based on the rules that we talked about. 36.65, we would be short. Now, our target, 26 ticks lower, is down here at 36.39. Now, our stop loss, 17 ticks. So our stop loss this time is actually triggered. Pretty easy to see that, but let's see exactly where we'd be. Okay. So when the market was bullish based on MACD, using the average daily range as an exit, we take 26 ticks or pips. Here with a short signal, we get stopped out for a 17 pip stop loss. So on the two trades, you know, we're still up for those two trades. We're up 9 pips. Now we get black bars. So black bars tells me that there's a crossover, and now we can look for a new entry if we do have our entry signals. This bar completes red. We're looking at 36.60 as an entry point. Our 16 or 17 tick stop loss is up here. Let me make it exact. 36.87. Our 26 tick target is down here at 36.34. So just barely squeaked this one out. We got down to 36.33, one tick through our profit target. As a futures trader, we know that based on this print, that we would definitely have been filled on our exit had we been filled at 36.60 with our entry. So, another opportunity, and we see that the stop loss was appropriate for this market move, and our target was just enough. If we were using 20% of the average daily range as a day trader, we wouldn't have been able to get down all that way, but 15% in this case was perfect. Now let's just go through 3 more examples. We'll keep it quick. 36.48 is our entry point based on MACD. 17 ticks. We're off a little bit on that one. It actually was 3 ticks lower, but you still see that we had plenty of room with this move because the market's always going to move. We're not just going to see a straight move down, so our stop loss appropriate on the move down. The 15% works very well as a day trader looking to take short-term trends. Again, we get through this move a few ticks, and then the market turns around. Here, 36.55, and I think you get the idea. So by using 15% of the average daily range as my target, 10% as the stop loss, and using rules for a trend following entry system, the average daily range gives us targets and stops that are appropriate for the market conditions, and we could capture some of these smaller moves, and our risk is going to be appropriate for those conditions. Now this changes if it's another day. If we go back to July and we're looking at 150 pip average daily range or 140 pip average daily range, then the target and the stop loss are going to be smaller. We're still going to make more on a winning trade than we will on a losing trade, but it's going to be appropriate for those market conditions. So again, as an example, I just use a basic MACD entry system. These exits on the far right weren't exactly right. I was just giving you an idea. But you could use the average daily range and your favorite strategy for entry. But, if you don't have a concrete exit strategy or you do not incorporate volatility into your exits, I think that at least give it a try. Give it a look. Give it a shot. And, see if it is something that will help you, because in my experience, a lot of traders, they find it difficult to trade when there are swings in volatility. Because if you're using fixed exits, when there's more volatility in the market, it's so easy to get stopped out on a trade. And by using the average daily range to use volatility-based exit, then you're letting the volatility set the stage and the parameters for that trade, and then you're just taking advantage of the moves that you that you're identifying. So there are a few questions on this chart, and I think I threw everybody off on this. I do apologize for not mentioning it earlier. So the average daily range, I'm sorry, that's not what I want to, range bars in the 60, which is basically the euro, US dollar, I use a 12-tick range bar, and that's what we see here right now. A 12-tick range bar, again, if you're new to range bars, I've presented this topic before for FX Trade, and I think in the forum there's actually a MetaTrader instructions on how to set up range bars. I think that's from a while ago. But the idea is, again, I said there's two things that I do to incorporate and really to take advantage of volatility. One is to understand the average daily range and base my exits on it. Two is to use range bars, because with a range bar, you get a new bar completing whenever a specified range has been exceeded. So if you're using a 20-tick range bar, every time a 20-tick range has been exceeded, you get a new bar opening up. If you're using a 4-tick range bar, then every time a 4-tick or pip range is exceeded, you get a new bar. And range bars are great, and they incorporate volatility too, because with range bars, when the markets are less volatile, you are going to see fewer bars. When there's more volatility in the market, you're going to have more bars. So when you have more bars, you have more potential entry points and exits, and that's what I like to have as a trader for my style of trading. So if you're new to range bars, again, I could go on and on and on about range bars and talk about it in detail, but I think it would be easier to focus more on the average daily range and how to use it in this webinar, but do a little research on it. I wrote an article on range bars for SFO magazine. You can go to sfomag.com and take a look at it, and I've also presented webinars on range bars for FX Street in the past. Okay, so Jack says, how do you measure intraday real-time volatility? What indicator? How do you predict the next future, exactly the next 5 hours? Well, see, that's the thing, Jack. I base my volatility decisions on the last 7 days, because in my experience, that is the best gauge. And yeah, there might be a burst in volatility. That's where my range bars come in handy, because my range bars are showing that short-term volatility and that burst. But in general, I'm looking at the last 7-day average to understand what type of volatility is normal for this market. And if we exceed that range, then I know that, hey, this is outside of the norm. If we're well within that range and it's very quiet, then I know that, hey, there's definitely less volatility here. But range bars are really that powerful 1-2 combination between basing the average daily range to assess volatility in the market and to get a read on current volatility as a day trader. Someone says, why sometimes 12, sometimes 16 with the range bar setting? Well, I've actually made an adjustment to 12-tick range bar. 16 ticks right now is appropriate for the range that we have. Again, anytime you increase the range bar setting and you make it a higher setting, you're going to have fewer bars. Anytime you have a lower setting, you will have more bars. And as a trader, I think 12 to 16 in the euro US dollar is a great setting for the type of trading that I do. And there's no real right or wrong there. Right now, I like 12 because it gives me more entry points. And based on the movements that we have, I find it easier to trade the strategies that I'm using. So Boyke says, how many trades on average? Yeah, again, it depends on my indicators. And this is where if I'm looking at a trend following trade during the U.S. session, there might be one or two. Here we see, just using MACD, there is one. This yellow zone is the U.S. session from 9:30 to 11:30 Eastern. So here, maybe there was an opportunity here based on those rules, and then a second opportunity here. For me, in the way I trade, there was one opportunity. I was looking more at this move here. Again, this just being used as an example. So, I mean, this could be done in any market. If we take a look at this is the pound futures contract, which again is just really the pound against the dollar. And right now we see that the average daily range is 126 pips. So for my trend following strategies, looking to identify trends in the market, I would be looking at a 19 pip target, and I would be looking at a 13 pip stop. Now someone asked, is this scalping? Well, it's day trading. It's day trading to me. This isn't scalping with the type of trading that I'm doing. And again, these targets and stops can change. For me, a 17 tick stop and a 26 tick target, again, pips, ticks being used interchangeably. I mean, that's a decent move for the type of trading that I'm doing, and I would consider a scalp to be 4 pips, which as a futures contract trader is a decent move when you're trading some size. So, William, I also worked with tick charts. I found that range bars were easier for me to use, and so range bars are my preference. There isn't because of the way that tick bars and range bars are calculated, there isn't an appropriate equivalent. But it doesn't mean that you can't use the average daily range target and stop even with a tick chart. Okay? Well, yes, what is the spread on these pairs? See, again, this is a question or debate on the pros and cons between currency futures and spot forex. With spot forex, you're dealing with a spread. With futures contract, you're paying commission to your broker, and there's really just a one tick or pip spread between the bid ask. That's basically between traders, since you're trading through a centralized exchange. So it's just it's giving, charting wise, we're comparing apples to apples, but when you talk about spreads, it's really different, because with forex, your broker's taking the spread as profit. With futures, your broker's charging you commission, and if there is a spread, it's just between contracts being traded between traders. Okay, so I want to cover another topic, and then we could get back to some questions. But this is what I do when I'm looking at trend following strategies. So I'm trading with the trend. When I'm trading with the trend, I always want to have a profit target that is greater than my stop, and to make sure that I'm looking at a target and I'm using a stop that's appropriate for market conditions, I'm going to base my target and stop on the average daily range. Now, there's another topic that I want to show, and I think that this could be great for forex traders. Let me go back to my slides here. Okay. So, as a day trader, I use pivot points to identify levels of support and resistance. And for me, these levels are important. However, there are times when you really start to see some big swings in the market where you might be exceeding, say, an S2 pivot point or an R2 pivot point, and so you're going outside of those pivot ranges, and I think that this concept is valuable. Another scenario, sometimes you might have big swings during the day. Maybe you move above the R1 pivot point, and then you come all the way back down below the S1 pivot, and you get this huge intraday swing. This concept can be very powerful in that scenario too, and we will look at a few charts so I could show you exactly what I mean. But what we found is that in most scenarios, a market has a very tough time moving outside of the average daily range. So if you know, based on the average daily range calculation, that it's really just the average between the session high and low over a 7-day period, and you know that most of the time your current trading day will stay within those ranges, whenever we go to exceed that range, that's a warning sign to me. And we could use the upper daily range or the lower daily range as a key support or resistance area. The upper daily range is calculated by the session low, adding the average daily range. The lower daily range is calculated by taking the session high and subtracting the average daily range. Let's go back to my charts and I'll show you exactly what I mean. Okay. So let's do this. Let's go back to the beginning of a week here. Let's see. Okay, September 12th was a Monday. So let's take the 12th here, and let's talk about the upper and the lower daily range. So let me write this out one more time. So the upper daily range is the session low plus the ADR, and the lower daily range is the session high minus the ADR. Now, you'll probably find that most trading days, this doesn't really come into play. So this probably isn't something that you're going to use every single day and this is for someone who trades intraday. But when you get those big days where the market's moving, this will help you at times determine either exit points or whether you want to enter a trade. So with this market move, we see that this is between Friday's trading and then Sunday night's open. So for the U.S. So here we see that we open down here, and then the market starts to move higher. So at the time, this was the session low. Here we have another attempt, but we don't get a new session low. And then here we start to break through the session low. So here's our new session low at 34.87. And then the market starts to move higher. Let's see if we get back above that level. We really start, oops, not what I wanted to do. Jump back. Okay. So if I'm looking at 34.87, that's our session low, and I see that the average daily range is 197 pips. I could take 34.87 and I can add 197. And again, like the average daily range, this can be calculated and plotted just depending on the software that you're using. But in this case, 134.87 is the session low, and then we add 197. Oops, 197, and that gives us 136.84. So from this low, if this low changes, then that's it. We make an adjustment. But right now, with the market trending up, let's see, 34.87 up to 36.84. Here we go. So based on this session low, as the market's moving, knowing that, hey, in general, the average daily range is at 197 pips, so that's what the market usually stays confined within during a normal trading day. Now, so if I'm looking at, again, if we're using just a basic MACD system for entries, there might have been a few good entries, maybe a few losses, kind of back and forth. But if I'm looking now for a nice move up here, the closer we get to this level, I'm thinking, gosh, we've pretty much exhausted the average move that we can expect. So instead of looking for long opportunities, I'd be looking for short opportunities, or I'd be looking for long opportunities on the way up to that level. So we're going to continue to move on. Actually, let me use another level here. There you go, marks it. So you see, now we've had a few more bullish moves. We had a push here, push here, push here. And after those attempts, we get back below a support level and we start to drift down. Now, the high of this move was 36.85. So that's 1 pip above the upper daily range. And again, how did I calculate this? Well, knowing the 7-day average range for this market, I know that in general, I could expect moves to stay within 197 pips. And from this session low all the way up to this level, that's as far as this market moved. Now let's continue to move. Now we could calculate the lower daily range, see if it comes into play now or not. Normally you don't get a run up to the upper daily range and then all the way back down to the lower daily range, because then that would be almost 400 pips of movement in one day. But if we took the 36.84 level, 36.84, and we subtracted 197, 34.87 would be the level we need to be concerned with as the lower daily range now. 34.87. Let me make it exact. So on the way back down, I would say, hey, if we start getting down into this level, then I want to be careful. And it just so happens on this day, this separates the day, and we got 1 tick through the average daily range. We stayed within the average daily range for the rest of the day, and that was it. Yeah, and again, there's a question on the average daily range. It's taking, during the trading session, it's taking the high, subtracting the low, and averaging that over 7 days. So, I mean, pretty neat here. We get within 1 tick of the average daily range. Actually, we go through it 1 tick. So, again, if I'm looking at getting into this trade and I'm going, yeah, it might be a decent, potential move. Here's the pivot point, but we've moved so far. How much do I expect this market to move now? And if you're assessing it, and again, if we're in a narrow range, or we just stay kind of confined within normal levels, then the upper range and the lower daily range probably don't ever come into play. It's these bigger moves when the upper and lower daily range can really help, and we could identify these levels as key support and resistance. So now on the next day started, and here we see that the average daily range is now 203 pips. So based on this move on this day, taking the average over the last 7 days, our average daily range has increased by 5 pips. So we'll go a few bars and start to see, again, if I'm just in a normal, 80, this 80 pip range is normal when the average daily range is 203 pips. So I'm looking for a bigger swing. Okay, now I start to see a little bit of a move here. So let's do a calculation. From this high, this occurred during the Euro session, the high at 36.85. I'll mark it on my chart. Now let's make it exact. 36.85. Now if I subtract 36.85 minus 203. 34.82. 34.82 down here. That's now my lower daily range. If we get a new session high, this lower daily range will come up. But until we get a new session high, the lower daily range will stay right here. Okay, we're moving higher, so let's do the math on the upper daily range now too. Because here, And I'm doing this by hand just because now you have a tool, you've learned how to do it, but anytime you can program it into your software, it makes it easier. So 35.46 right now is the low for the session. So if we add our average daily range of 203, that would be 749 up here. I'll make it exact, 749, and we'll just draw that support level. That's close, we'll know. Alrighty. Well, you see on this day we stayed within the range, which is normal. We didn't get up to it, so it didn't act as a resistance level, but we got within it pretty close. And so again, if I'm looking for a trend, if I'm trying to spot an opportunity and I see, hey, I could get into this trend here and I could easily make my profit target and based on the average daily range, that's a pretty good opportunity because we might get up to this level. But if we start to get up to this level, do I want to go long up here when we've moved so far? And based on all of my experiences and testing, it's very, very difficult to get through the average daily range during a session. No, probably not the best trade, and it would be better to look at short opportunities. So I know that actually I could talk about this all day, and I could give dozens of examples, but unfortunately we have some time constraints here. I hope that I made it clear enough, but I mean, this really works for any market. It works for any market. Here's the pound. The high, this was I think yesterday. So the high was 57.41 actually, and if you take the average daily range of 126, now look at where this low ended up. I just kind of eyeballed it, but we probably hit the average daily range perfectly actually. So it's important to understand ranges. It's important to understand market volatility, and at the very least to assess market conditions based on market volatility to ensure that it is a market environment that makes sense for you. In my opinion, it makes sense to incorporate these ideas into your trading. By using volatility-based targets and stops, you can trade any market condition. If you are trading into extreme ranges and there's hyper volatility in a market, then knowing where those ranges are and using them as support and resistance levels could help you have more realistic expectations in the market and from the moves that you are expecting. That's going to do it for me, guys. Hey, if you have any questions, feel free to email me, support@rockwelltrading.com. Now, I always love presenting for FX Street. They're a great company, and they have lots of excellent information available and for free with these free webinars. So take advantage of it. If you have any questions for me, support@rockwelltrading.com, or Google the concept, because I've written a few articles for a few trading publications. And with that said, I'll leave it at that. Everybody, happy trading to you, and have a fantastic trading day.